recording. Let me start recording and okay, and share my screen, entire screen. All right. So you'll be able to see. Connection is poor right now. Okay, that's not the. All right, we have like 5 people currently, and more people are joining. So we're moving on to the second topic today, and before we do that, let me quickly go to the assignments folder, and you have this test, right? Currently due tomorrow. Thursday's tomorrow, right? And then right after that, I think the announcement went out today as well. There will be a second test because we have already finished topic 1. We're moving on to topic 2. So there's a second. Where is it? There's a second test coming up. Okay, so yeah, it's posted today. So there's the ROI practice and self-diagnostics, which will start Friday and due Sunday, right? So it doesn't show currently. It doesn't show in the assignments, but since it is starting from 28th, it's gonna show. Now it's not showing to you. See, it is all grayed out, but on the 28th, it's going to be visible. Okay. All righty. So that's the upcoming, the current test and the upcoming test, and we are moving on to the financial statements today. And I have, of course, there is this PowerPoint slide, and there is Excel file on top of. If you go into the topics folder, right? Second topic folder, right? This is the that PowerPoint PDF file, which is a PDF of PowerPoint. Financials. This is the Excel file. You need to download them, right? And the first video, intro 1, right? I'm going to play that, and I'm going to pause every once in a while to add more explanation or skip some parts that are not critical or essential, or pause whenever there's a question. Okay? Let's take a listen. In financial accounting, this is basically you've probably heard of financial statements. Financial statements refers to the 4 basic statements in financial accounting. This is this part has a lot of overlap with financial accounting, but we're not interested in financial accounting is inevitably the starting point of finance, but it's not accounting. Accounting has different orientation, but as far as it's financial accounting, it's basically the common ground between finance and accounting. Now, so 4 statements are first income statement. 4 statements in financial accounting is first income statement. The full name is actually income and expenses statement. Income and expenses statement. Second one is balance sheet.
Please bear with me. As I said before, it's not really writing. It's drawing with mouse. So third statement is called cash flow statement. Cash flow statement or cash flow analysis. Okay. Fourth statement is retained earnings statement. But in accounting, they call it also owner's equity statement. Retained earnings. So actually, number 4, retained earnings statement is relatively secondary in importance. I mean, it's of course also important, but what I'm saying is, if you the fundamental 2 statements are income statement and balance sheet. So if you can analyze income statement and balance sheet correctly, then it tells pretty much about how everything that will serve the purpose of the investor, right? Cash flow statement is actually, very important, and because when you are evaluating stocks, the cash flow projection is cash flow estimation is very important. Cash flow statement and cash flow estimation are slightly different, but the importance of the cash flow statement lies in the fact that cash flow statement is a meta-analysis of income statement and balance sheet, right? You cannot have a cash flow statement unless you until you have a good analysis of income statement and balance sheet. Yeah. So the point is, we actually, for the purpose of this class, we're not going into a cash flow statement or retained earnings statement, because these 2 will be discussed in more depth in the next class. I mean, in the next course, in the advanced course called corporate finance, FNB 230 corporate finance. Now, income, but why are we going into suddenly financial statements? I mean, financial statements are for businesses. In other words, if you're not a business, as a single private individual, you don't have financial statements. Right? I mean, you can make your own financial statements and keep it, right? Keep the record of the financial statements, keep updating it, but it serves no purpose, right? I mean, it serves no practical, or to be more specific, it serves no tax purpose. But all the businesses must keep the financial statements. Keeping financial statements meaning, keep track of it, update it, right? Keep updating it. Updating means, how often do you update it? It's not random. I mean, you can update it every day or every week, but that's totally, that's just at your discretion. It's not what is required by the law. But what is required by the tax law is that you, or I wouldn't say tax. Rather than tax law, it's the by GAAP, right? Generally accepted accounting principle, or IFSB, International Financial Standard Board, right? I mean, in other words, by professional practice, right? They update it quarterly, every quarter, right? Which means, updating, it's necessary to update it quarterly, because for every business, right? For every business that is selling stocks to the stock market. I mean, if a company is selling stocks to the stock market, it's not every company that can sell stocks to the stock market. The company has to be accepted by the stock market, or a specific stock exchange, like New York Stock Exchange or American Stock Exchange or NASDAQ, right? So not every company can be accepted, right? You have to meet certain standards, right? And when company goes, that's called also going public. In other words, what does that mean? When company goes public, that means the company is selling stocks in the stock market. Going public means the ownership of the company is open to public now, right? Previously, prior to going public, the ownership is only open to a select few individuals, right, or institutions, right? So ownership is closed. Not necessarily because they want to keep it. Sometimes they want to keep it private, but if you keep the ownership private, that means you are limiting the company's availability to the stock. Company's capability to raise capital, right? In other words, if the ownership belongs to only 10 individuals, right? The maximum capital they can raise is the financial ability of these 10 individuals. Of course, when I say individual, an institution can be included, but even an institution, right, or venture capital, their capital investment, they have a maximum level, right? The availability of the funds to invest in this company is capped. And of course, even if there is out of 10 original shareholders, even if there is one, let's say one shareholder was a venture capital, even if it was a venture capital, right? A venture capital would not pour in the money to a bottomless pit. You understand? A company should be generating profit, right? And then whoever is the investor is willing to put in more money into it. Make sense? So that means the ability to raise capital is limited when the ownership is private, right? But when the ownership is open to public, that means you can tap into a large stock market, right? Large capital market, specifically stock market, and then you can sell stocks up to let's say there's no limit, but the thing is the limit is automatically there's no set limit. I mean, the limit is set by the demand and supply, right? For example, there's suppose this company X is going public, right? And their ceiling, the maximum amount of capital they can raise, depends on how much demand there is in the market for company X's stock. So if there's enough demand, maybe and the equilibrium for that would be probably $10 billion or $100 billion, $100 billion. So stock, it depends on also on how much is the IPO price? In other words, initial public offering price, IPO price. And if IPO price is $100, and if the $100 is perceived as a fair value by the market, or slightly below fair value, if it is below fair value, that means it's a good deal from the buyer's perspective, right? There'll be a huge demand. And let's say if the IPO price is $100, and if they sell to reach $10 billion, 10 billion divided by 100, you cancel out 2 zeros, cross out 2 zeros, that's still 100 million shares, right? If there's that much demand in the market, the company can tap into $10 billion capital, right? The $10 billion capital is used for supporting its activities, supporting its operation, expanding its production capacity, and it can be used for a lot of things that the company is planning to do, right? That's the meaning of tapping into an open capital market, right? So now, as I said, we are going to look into income statement and balance sheet mainly because these are the primary statements, right? Primary statement. As I said, cash flow statement is, I wouldn't say is the cash flow statement secondary. It's in a way it can be considered as a secondary statement. A secondary not in importance, but what I'm saying is only when you have a good analysis of balance sheet and income statement, then you can have cash flow statement. So in that sense, it is I'm calling it secondary because you have to primarily have income statement, balance sheet. Now, and another thing we have to think about at this point is, so I said financial statements are for the businesses, right? So how does that connect with the previous topic, return on investment? Look, return on investment, we looked at the return on investment from macroeconomics perspective, right? What is the baseline of return on investment from macroeconomic perspective? Now, in the second topic, we are looking at the return on investment from microeconomics perspective, right? So a firm is a typical actor, a player in microeconomics, an individual or a household or firm. These are the players in the microeconomics. And so as a company, right, if you're running a company, as a business, all the businesses, what is the goal? What is the objective? What is the goal or objective function, objective of, it's called objective function, right? All the businesses have only one objective function, right? What is the objective of any business? Every business or any business? Does anybody Some people, I know, because I've been teaching, finance and economics for more than 20 years. And every semester at the beginning of the class, if I ask, what is the goal of the firm, they all say to make money. That is a very vague statement. Why? Because what does it mean to make money? Hmm? To be more specific, making money means to make profit, right? Isn't that right? Suppose, let me give you an example. You bought iPhone 10 for $1,000 and you sold it for $1,000. Did you make money? Everybody will say, no, you didn't. Why? Why not? I mean, because it's obvious you didn't make any profit. I mean, you used your 1,000, just sold it for 1,000 again. Why did you do that? What did you do that for? Huh? You just passed on the iPhone, the merchandise, right? For no gain. I mean, why go through that, cumbersome process, right? You're just handing it over to someone. So obviously we know making money doesn't mean just simply, receiving money, right? Making money means clearly making profit. But what level of profit? I mean, so you bought iPhone 10 for $1,000 and sold it for $1,001. Did you make money? Yes, you did, because you made profit of $1. But is that $1 profit acceptable? Everybody will say it's not. Why? Because you took the trouble of buying iPhone, going to an Apple store, right? Use your credit card or pay cash, or well, you took the trouble of going there, buying it, and then took the trouble of finding a buyer. Just made $1 profit. Is that dollar is worth all that trouble? So obviously, then what should be the level of profit that is acceptable? You might say 10%, 20%. Why not? I mean, why don't you push it further? 100%. If you can make 100% from this, that means you're selling it for $2,000, right? But then the question is it sellable, right? Obviously, if the price is too high, right, the chances of selling it would go down. So the correct answer is you want to make the maximum possible profit. Maximum profit, right? Maximum profit doesn't mean 100% or 200%. We don't know what that maximum profit is, but maximum possible. It could be 50%, it could be 30%, right? Profit. But the point is, the goal of or objective function of every business, any business or every business, is to maximize profit. Make sense? Maximize profit. Now, the symbol pi, you remember this? The pi was the symbol for inflation in macroeconomic context, but in microeconomics context, the symbol pi is the symbol for profit, right? So the objective of, or the goal of every business, no matter what they say, on their public relations, public relations, in their commercial, the commercials generally relay some public relations message. They or promotions, they public relations promotional programs. They always portray themselves as some kind of philanthropic organization, as if they exist. Their whole purpose of existing is to serve the community, as if they are a public service organization. No, that's just a facade. They put on a cover like that. But once you take off that cover, inside, right, the sole purpose is not to serve the human race, but to maximize their profit, right?
I guess I can skip this part.
Profit is the profit belongs to whom? Who does the profit belong to? Owners of the company, of course. Some people may say to the company. No, company is an inanimate entity, right? Company is simply a vessel, right? Isn't that right? Company is only an inanimate entity. Company doesn't know. Does the company spend that money? I mean, or a company is only a vessel, isn't it right? It's actually the owners the profit belongs to. And once the owners cash out the profit, then they use it, right? They spend it or do whatever. So the goal of any business is to maximize profit. But there's another phrase, right? You can paraphrase it as maximize shareholder value or maximize shareholder wealth. Why? Because profit is the shareholder's wealth and shareholder's value, and company is a vessel to realize to maximize the shareholder's wealth. Okay. Now, And who are the shareholders are employees are not shareholders, right? Employees are hired by the company, and some companies, as an employee, if you buy the shares of the company stock, if you can be an Apple employee and you can buy Apple stock, right? Ownership is not such a glamorous thing. If you think owner of a company sounds like one single person, one individual. No, it's a sole proprietorship. If one owner, there's a single owner who owns the entire company, that's a single ownership or sole proprietorship, right? In a corporation, the ownership is diversified. The ownership is distributed across a large population of a large number of shareholders. So majority shareholder, usually majority shareholders have about somewhere around 10% of the total shares, right? And if you are Apple's employee and if you own Apple's shares, but your ownership is how much your ownership is going to be like. Probably 0.00000000001%, right? Now Apple has about $1 trillion market capitalization. That means the market value of Apple's stock is about $1 trillion. I'll have to check this again because Apple reached $1 trillion market value.
That was already a couple of years ago when I made this video, right? When I made this video, that was like early 2020, and at the time, Apple was just about Now Apple even reached 3 trillion point, right? That was even a couple of weeks ago. There was a lot of fanfare about that. There was a lot of fanfare. Apple reached 3 trillion. And which other? Google or Microsoft reached like 2 trillion, close to so you need to take it with some grain of salt, right? You need to take it with some grain of salt. You need to take into consideration that this video was made like at the beginning of the pandemic. So obviously, there has been some change, right? Some updates.
Valuation, as far as I remember, about about a couple of years ago or last year, and Amazon has also more than $1 trillion market capitalization, right? That means $1 trillion is a huge amount, right? Of course, that's not the revenue, right? Market capitalization means market value of the stocks, okay? And the revenue, I believe, revenue is also. I'll have to check the revenue of Apple and Amazon later. But the point is, so profit belongs to the owners, and the I used to be an Apple shareholder, but shareholder is minority shareholder, right? I was a minority shareholder because I had only 10 shares of Apple. That was back in 2012 through 2014, I believe. And then so 10 shares. Apple may how many shares are outstanding? I don't know. I'll have to check. But there may be like 1 billion shares outstanding. Out of 1 billion shares, 10 shares is what? Right? You cross out 1 0. That's still 100 million, right? 1 out of 100 million in terms of percentage, right? How many zeros, right? 1 over 100 million. 6 zeros, 8 zeros. So that would represent 0.00008 7 zeros and 8 zeros and 1%. I mean, in terms of percentage, it would be 1% is 0.01. So like 10 zeros are like you cross out 2 zeros out of 8, right? So 0.00606 zeros and 1%, 0.0000006 zeros. If I did count to 6 zeros, if I said 6 zeros already, and 1%, right? Such a minority shareholders, Apple doesn't care. They don't know who I am. All minority shareholders are anonymous, completely anonymous, because my stake in Apple is as light as 0.0000001%, as shallow as that. And my connection with Apple, my ownership, my relationship with Apple can easily be severed once I sell my shares. Make sense? So if you have like 11%, 12%, you are already a majority shareholder, major shareholder. And if you're a major shareholder, you would be on the board of directors. You will be on the board of directors, right? And each, because number of shares represents the number of votes. Because if you're an owner, how do you exercise your power or right as an owner? I mean, what comes with the ownership? Ownership comes with with every ownership comes the voting right. If you're an owner, how do you what is good thing about the ownership? If you're an owner of something, I mean, if you're one of the let's say you own a business, but not just yourself, but collectively own a business, 10 owners. So in this case, there will be a partnership. If there are 10 partners and your ownership is 10%, everyone's ownership is 10%, ownership shares are 10%, then in making a decision, major decision about this company, you will have to convene a meeting, isn't that right? You'll have to meet and discuss, what, and how would you exercise your ownership? Through vote, right? So, but think about it. Someone with like 12% ownership, right? 12% shares, then will cast a vote that weighs 12%, right? Of course, in every voting, right, 51% is the supermajority, right? There's nothing you can't do with 51% vote, but nobody has 51% shares, right? So in reality, usually, the friendly owners, right? Friendly shareholders, they form a pact, right? And then they vote together. I mean, this is going to take a lot of time, so let me come back to this, right? Let me come back to this in the next video. But before I go, so think about it. This profit is basically return on your investment. If you have, right? If you have shares in a certain company, company X, the profit, not just the profit that belongs to you. I mean, think about it. If I have 10 shares, and that's 0.000000001% of Apple, Apple's total profit, I only out of if Apple made $1 billion profit, only 0.0000001% is mine. But again, that profit is not distributed to me. Company doesn't distribute the profit to the individual shareholders. Why? I'll leave that as food for thought for the next class. So please.
All right. So I was saying that Apple's market capitalization is above 3 trillion. Yes, it's actually, as of today, market capitalization is 3.059 trillion. Now, remember yesterday you saw GDPs of some major economies, 15 largest economies, right? And 3 trillion is like, UK or Germany, right? 3 trillion is like UK or Germany. I mean, UK and Germany are slightly greater than 3 trillion, but so Apple's market capital. And how many shares of Apple are there? And think about it. Today, Apple was the market ended. Apple's market price at the closing of the market today was $194.5, right? So roughly about $195. So you divide. Think about it. If you simply divide 3 something trillion, let's say just 3 trillion. If you divide, it's actually 3.059 trillion, but just approximately, if you divide 3 trillion by 195, and that's going to give you how many shares are there, right? All right, so we're going to move on to the, I'm going to come back to this later, okay? Let's go to the second one.
Second lecture in the financial statements. So in our last video, we discussed how return on investment is related to the financial statements. And we discussed, what is the objective function of the firm, and we understand that the objective function of the firm is to maximize profit, and the profit is the investment.
Okay, skip that part.
There are two types of capital. One is equity capital, and the other one is debt capital.
Okay.
Think about it. In other words, capital provided to the company or the investment on all the investors' input, and the profit is the return on all the investors' input or the investment. In other words, capital provided to the company, right? So if you think about it, there are two types of capital. One is equity capital, and the other one is debt capital. Okay, debt capital is basically supplied through bonds, because you understand from the previous topic you learned that the debt is bond is a debt instrument. So the way one of the two ways that the company raises capital is through either debt or through equity. Equity is basically they usually call it owner's capital. What that means is the capital provided by the owners. Well, who are the owners? As I said in the previous video, in a modern corporation, there are numerous owners, right? And the owners can be institutional or individual shareholders, and the ownership is basically represented by the shares in the equity capital. So equity represents basically stock, right? Equity is the basically stock, and the stockholders are the equity holders as well as owners. And of course, as I said, the ownership is represented. Ownership is a collection of numerous investors, shareholders, right? And most of the shareholders are minority shareholders, right? And the majority shareholders, who owns, something like 10%, 11, 12%, all, pool their. There is a reason why the majority shareholders pool together. There are those who, not all of them pull together. Some pull together against the other group, but the minority shareholders. What I'm talking about is minority shareholders are all anonymous, right? And so the profit is the output onto the input, which is the equity capital provided by the shareholders. But there is another type of capital, and there's also debt capital, right? Debt capital is also a part of the input, right? But then think about it. The providers of debt, in other words, debt holders or bond holders, right, have no claim in profit, right? Because they're not owners. They're not. Debt is not ownership. Debt is what the creditors loaned out to the company. So as long as in any case of loan, right, just like in any case of loan, as long as the creditor gets their capital back with promised interest, then that's it. That's what the lenders do. That's what the creditors do, right? That's what the bondholders do. But the profit is the result, the final result, after paying out all these interest and the lenders' capital back to the lenders, right? So whatever is remaining belongs to the owners. Now, so the profit is the output, right? Output, against the input that was, the equity capital provided by the shareholders. If that's the case, the point is, what is the return on investment in this, in the case of, a firm? What is the return on investment, and how do we maximize the return on investment? Well, that question also is tied in together with how we maximize the profit. Now, so in measuring the return on investment in the firm, right, there are largely two measures: ROA, return on assets, return on total assets, and ROE, return on equity. Okay, so to explain this, we will need to go a little further. But here, we'll start with the income statement. Why? Now, so it seems like if you have no prior knowledge, in financial accounting or financial statements, to be more specific, you might tend to easily think that everything in financial statements is all about profit. No, the answer is clearly no. Each financial statement has different purposes. The first, income statement. The goal of the income statement is profit, right? In other words, income statement is a description of the process that leads to profit. Okay, so income statement is about profit, but the balance sheet, the goal of the balance sheet is not profit. The goal of the balance sheet is capital structure. The goal of the balance sheet is describing the capital structure, or explaining the capital structure. Okay, so this. So they have different goals, no? Let's move on to the income statement, right? So to explain the income statement, I will need to erase everything here. So let me erase, and then so income statement, as I said, is the full name of income statement is actually income and expenses statement. Okay. So it starts with listing all the sources of income, right? But there are largely two sources of income. One is sales revenue, and the second source of income is investment income. Now think about it. What do you think is the primary source of income for any company, right? The primary source of income is sales revenue, because all companies must sell something, right? Now here's the interesting thing. I mean, some students may have already taken accounting, but when I ask what is revenue, there comes out all crazy answers, all free-floating, freewheeling answers. What is revenue, first of all? Some people say revenue is what you get after subtracting cost. Some people say no, but people who say revenue is I mean, let me give you an example. Suppose you're a computer manufacturer, like Dell computer. Let's say you're making a computer. Let's say you are making Model X, right? And this Model X, to build this computer, it cost $300. Of course, to build a computer, what goes into a production of a computer? You will all say, oh, there's a CPU, memory chips, and the keyboard. Yeah, we call that all of that. We label it parts and components. Isn't that right? Parts and components, or raw material, right? Raw material, right? But that's not the only input that goes into the computer. There's got to be labor, right? Right? Who puts them together? Who assembles all those parts and components? Who assembles the materials? Now, is that the only thing? What if they use the robots? If you use the robots, then labor is can be minimized, right? If you use robots, what's that called? It's called capital. Okay, robots or no robots, right? Still, even if it is intensively assembled by human labor, still the human labor will have to use some capital. The capital in this sense is physical capital. It's not financial capital, but physical capital. And the definition of capital, I don't know if you've taken any economics, but if you have taken economics, physical capital is the main definition of capital. Capital is something that serves to produce another thing. That's capital, right? So in other words, production equipment. I mean, even if it is all 100% automated by robots, right? If the company would, a manufacturing business would inevitably, it will have to have a factory, a plant, right? So the three inputs of production, or three factors of production, are capital, labor, and raw material or natural resource. Now, capital means in this case physical capital, so it means plant and equipment. right? Or yeah, manufacturing equipment, right? That's capital. Without capital, physical capital, there can be no manufacturing. Make sense? So let's say to build one computer, one unit, the input cost is all $300, right? $300. That means, a direct cost for labor, capital, and raw material, they're all $300. And then, of course, once the computer is built, you don't sell it for $300, right? That's stupid. So you sell it for $500, right? And that $500 is called what? Price. That's price, right? Make sense? Now, so what is revenue? Revenue is when you sell one unit, how much do you receive? $500. Isn't that right? That's revenue, right? If you sold 100 units, how much is your revenue? Right? 100 times 500, right? 100 units times $500. So then that's going to be $50,000. If you sold 1,000 units, that's going to be $500,000. If you sold 1,000 units, that's going to be $5 million. So if someone answered like, oh, after subtracting expenses, revenue is what's left after subtracting expenses, then what does that mean? In this example, is it going to be $200? Is that the revenue? Huh? No way. If you subtract the expenses, then that means you're subtracting $300. Then you have $200 left. That is roughly the concept of profit, not revenue, but that's not exactly the net profit yet. It's just if you subtract only the direct cost, that is called gross profit. Gross profit. But I'm not going to. Okay, I'm going to come back to that later. So here we can come to a definition of revenue. So what is the definition of revenue? So you already saw it. It's like $500 that you receive, for sale of your product, right? But then that's a verbal definition. The verbal definition is not a very smart thing, because verbal definitions always transform. It's like, everyone, I mean, even if I explain it to you verbally, right? And verbally it's, what the payment you receive for, money you receive for selling the product, right? But then, once again, after time lapses, someone will say that, silly thing again, that, oh, that's what you get after, subtracting expenses. No. Why does this happen? Although we define it very clearly, right, in verbal terms, why does that continue to happen? Because people do not pin down their ideas in a very concrete terms. It's like, a phone. It's like a phone. It's like a telephone game. When you were a kid, you probably played this telephone game. You line up like 10 people and whisper a message into the ear of the first person, and then you pass it on to the next person just by whispering in the ear. And when this message gets to the last person, you would have noticed the message has completely transformed into something else. And why did it happen? It's because people add their own interpretation every time. So it gets rephrased and paraphrased and rephrased and paraphrased over and over. So then the message turns into a complete monster, right? That open to interpretation thing, that's something we don't like in economics and finance or in mathematics. That's something allowed in liberal arts, like, literature, right? Open to interpretation. Well, beauty is in the eye of the beholder. Oh, what are, very liberal. You may embrace, you love that idea. Beauty is in the eye of the beholder. Of course, it's in art, it's very subjective, but in science, truth cannot be subjective. Truth is objective and objectively congruent. In other words, there can be no. In other words, it's closed-ended. It cannot be open-ended, right? Something that everyone can agree beyond the shadow of even the slightest ambiguity. So, how do we define then revenue? It's simple. Think about it. What example did I use? I said, when you sold one unit, what's your revenue? $500. When you sold 10 units, $5,000. When you sold 1,000 units, 100 units, $50,000. Sold 1,000 units, 500,000. 500 units, 100 units, 1,000 units, $500,000. 10,000 units, $5 million. And if you sold zero unit, what's the revenue? Zero, of course. So what rule do you find here? What common rule do you find here? Wasn't it simple? Isn't it price times quantity sold? Price times quantity sold, right? Price times quantity. Isn't it indisputable? Isn't it infallible? Right? There can be no argument about it. It's indisputable. Nobody will argue or dispute against it, because that's objectively the truth. That's objectively what it is. Nobody can deny. Revenue is simply price times quantity sold, right? Right. So that's so keep that in mind, right? And it will have linear characteristics because it increases linearly with quantity. Now, so that's the primary source of income. Secondary source of income is investment income. So think about it. When company has finally, what is the investment income? Investment income is like interest from bond or lending and dividends paid from stocks. So it makes sense. What does the company do with the profit? There are two things that the company does. At the end of this process, then we will get to profit. Profit is like you might say so doesn't the profit belong to the owners? Yes, theoretically it belongs to the owners, but I told you, companies don't distribute the profit to owners. Isn't that right? Companies don't distribute the profit immediately after the operating period, each operating period. And what did I say? All the companies, they update their financial statements. How often? Quarterly. Especially, the companies that are publicly held or publicly traded. In other words, companies that are traded in the stock market, whose ownership is open to public, it's required by the Securities Exchange Commission, right? And I told you, Securities Exchange Commission is the regulatory authority in investment banking. In the financial market, it's right. Securities Exchange Commission is the regulatory authority, and it's the rule that all the companies that are trading, whose stocks are being traded in the stock market, must report, right? Update their financial statement report, right? The filing of financial statements quarterly, which is called 10Q report, and also annually, which is called 10K report, right? So and then at the end of each operating cycle, you are the bottom line of this process is profit, and that profit that's not being distributed to the owners, and it doesn't have to be distributed to the owners. Why? Because companies need that capital, and the profit is a source of new capital that can be reinvested. And the company needs to, if the company is doing well, they will need to expand their production capacity, right? If they will need to open up new, probably outfits, right? New like Apple stores, right? All their retail outlets, or all this requires capital, right? All this requires capital, and so. So what is the source of that capital that they, the profit is the source of the capital that they can use for expansion. The profit may not be sufficient for the planned capacity expansion, but then if that's the case, they can borrow more or, sell more stocks. But generally, profit is being used up for their own growth, right? Now, if they don't use it for their own growth, suppose their growth prospect is not that good. Their growth prospect is, at best, 3%. And if so, their the return on their investment in growth would be about 3%. And then what if they and this is below the average market return? If this is below the average market return is, let's say, 8%. So then what kind of company, what kind of management would decide rather choose to invest in their own expansion over investing into the market and earn at least on average 8%. Make sense? So of course, the profit can be either some of the profit, a part of it can be reinvested for growth, and part of it can be invested into the market. And if it is invested in the market, that means they are not investing. They are buying the stocks of other companies in the market that are doing well, right? A company, or buy bonds of the companies that are doing well. So that way they are. It's like using your, in case of personal finance, if you're using your own savings to invest in CDs or bonds or stocks, it's just like that. So from that investment, you get dividends and interest. That's called investment income, right? Okay. Now then, expenses. Now some people might ask, so what is then what about rental income? If it is, think about it. Those are just small subcategories of investment income. Think about it. The company can use their profit, invest their profit into the stock market or bond market or even real estate, right? Rental income is a kind of investment income, right? Just look at the big, broad outlines, minor subcategories. We can always, flesh it in or flesh it out later on. Make sense? The big skeletal structure, identifying the big skeletal structure is more important, right, than the minor, flesh part. Now, and also in expenses, there are two broad categories. One is direct cost, which is also called direct cost, which is also called CGS. Now, CGS is accounting terminology. That stands for cost of goods sold, which is also called total variable cost. Okay, total variable cost comes from that terminology is microeconomics terminology. I'm gonna come back to that later. And the secondary source is indirect cost. Indirect, which is also called OPEX. What does OPEX mean? It stands for operating expenses. Operating expenses. Okay. It's also called TFC, or total fixed cost, in microeconomics. Now, operating expenses is accounting terminology, right? Now, we're gonna. I'll have to cut the video here, and we'll come back to this in the next video. Stop.
Alrighty, so we're moving on to the third video, right? And I know this third video will run for about 30 minutes, and so we will have to pause it at some point at around 7:15 or something like that to take a break. During the break, I will introduce you to Anna Karen, our supplemental instructor. So just wait until about halfway through, right? Okay, let's.
Dr. Jeff Hong, and the intro. We started on the structure of income statement in our last video, and so to recap what we talked about last time,
I guess we can.
There is the structure of income statement. Is short sources. First is the sales revenue as quantity. Better definition. That's right. It's an expense. Second one is cost of goods. It's also called total with rewrite. I mean, this works approximately equal to total. Now it's very well defined by microeconomics. It's capital, labor, and raw material production, or factors of production, right? Cost. And what is the direct cost? So the cost we are talking about is the direct cost. And what is the direct cost? The cost that cost of direct inputs of production, right? We discussed it in the last video. And the direct inputs of production, or factors of production, are very well defined by microeconomics. It's capital, labor, and raw material, or natural resource. Right, and we assume Dell computer, right, and we assume Model X, Dell computers Model X, the direct cost, the direct input cost of in other words, the cost of capital, labor, and raw material are altogether $300. Okay, so. But of course, they when they sell it, they're not going to sell it for $300. Let's say they are selling it for $500. Okay, so $500 is the price. So if they sell 0 units, then their revenue is 0. If they sell 1 unit, the revenue is 500. If they sell 10 units, 5,000.
Okay, this part is.
If they sell 100 units, price is the concept. In other words, cost of goods sold, it's $3,000. If you sold, the concept. In other words, cost of goods sold, goods is already in plural. So if you sold, 10 units, it's $3,000. If you sold 100 units, it's $30,000. In other words, the direct cost of the quantity sold, right? That's what is meant by cost of goods sold. And then, because $300 is the cost side of the revenue, right? Makes sense? $300 is the cost side of the price. Now, but then it is also per unit production cost. Actually, $300 is the per unit production cost. Per unit production cost. Okay, makes sense. Now, it is also called the total variable cost in microeconomics. And why is it called that way? Now, variable means something is varying, right? Changing. So what is varying? It sounds like the cost is, no, cost is $300. What is varying? Output level, right? Output level is changing. In other words, what is the total variable cost when you produce 0 unit? If you produce 0 unit, total variable cost is 0. If you produce 1 unit, total variable cost is 300. If you produced 100 units, 10 units, total variable cost is 1,000. Produce 10,000 units, 100 units, total variable cost is 30,000. Sorry, 1,000 units, you produced 1,000 units, total variable cost is 300,000. So in other words, total variable cost is per unit production cost per unit times quantity produced. So this can be rewritten as, total variable cost can be rewritten as also average variable cost times quantity. Average variable cost times quantity. Okay, average. So what is average variable cost? Production cost per unit is average variable cost. Isn't that right? What is average? Average is basically total divided by quantity. Isn't that right? Because if the total direct cost or total variable cost is 300,000, if you divide it by quantity, 1,000, gives you exactly 300, right? Which is production cost per unit. But you divide it total by quantity, so that's average, right? And then average times quantity is total. So 300 times 1,000 units, 300,000, right? $300,000. So think about it. Anyway, in this case, we are dealing with industrial product. In other words, computer is a standardized product. Isn't that right? Computer is the same model. Let's not assume any variant, right? But just the same model, Model X. It cannot be different. It cannot be, there's no reason for the price to be different from one unit to another. Of course, eventually, the price will have, after reaching the maximum point, then the price will have to come down. Now, let's think about it. Price cannot be maintained at the same level forever because, first of all, because of demand and supply. When the market is saturated, right, up to a certain point, you can sell the product at some given target price. But once it reaches the max, once it reaches the market saturation point, I mean, everyone who wants to have it and who can afford to have it all have it. Everyone has it. Then the price has to come down to push sale, right? That's the case of price. In case of average cost, right? Average cost is relatively constant up to a certain point. I mean, average production cost would also have to actually, it would increase after a certain point, because in microeconomics, the marginal cost will drastically increase after a certain point. But the manufacturers generally maintain the production level within the constant average cost range, right? So it's pretty much a steady, constant number. I mean, cost of a standardized product cannot vary from one unit to another. So it's basically everything is average, right? Cost is the per unit production cost is exactly the average. Now, so we understand that what direct cost is and what is indirect cost. Indirect cost is the cost that is not directly related to production, right? This cost is not directly related to production. So if it is not directly related to production, what kind of cost is not directly related to production? Well, to give you an example, operating expenses are a very good example of operating expenses is rent, right? Suppose you are renting an office space, and it is a fixed cost in a sense, because rent doesn't increase or decrease with the production level. In other words, if you're renting an office space, just because in a particular month your revenue is great, excellent, right? Your revenue doubled in a particular month. Does that mean you have to pay double the rent? No, you don't pay double the rent. You pay the same rent, regardless of your revenue, right? And in a particular month, you had your business was very bad. Your revenue was not even half the average month, the revenue of the average month. Then does that mean you can pay half the rent? Of course, you don't. That's not possible, right? So in other words, regardless of your revenue, right? Or regardless, revenue depends on what? Of course, revenue, it's output level. Revenue depends on output level, isn't it right? If your output, if you produce more, if your production level is greater, and the revenue would generally be greater because you have a bigger sale, right? So unlike the direct cost, which directly changes with the production level, indirect cost doesn't change with the production level. And rent is a very good example of that. And the second example is the clerical staff. Now let's think about it. When you double the production, right? When you say workers or employees, you think they are all the same. No, they're not all the same. There are two types of workers, two types of employees, right? One, and especially this is a manufacturing business, and we assume computer manufacturing like Dell. Now, in manufacturing, there are clearly two types of employees. One is the production workers, right? Production workers. In other words, the workers that are directly involved in production process. So the workers that are working on the assembly line, workers that are directly related, involved in production activity. And there are a different type of workers, clerical staff. In other words, a secretary is a very good example of clerical staff, right? And they are not directly involved in production activity, production process. So suppose the company increases the production by double. In other words, the company doubles the production level. Company, the business is so good, they want to double the production. Then what do you need to do? Everything, all the inputs will double, isn't that right? All the inputs of production will double. In other words, labor will double, raw material will have to double, capital usage will double, right? And in terms of labor, doubling the labor, there are two ways. In other words, you can hire twice as many workers, twice as many, right? Literally doubling the number of production workers. Or you can keep the same number of production workers and just double their hours, double their working hours, right? Of course, in reality, people cannot, it's not humanly possible to consistently put the workers on double time, right? If you work 8 hours a day, for a couple of days, you may work 16 hours a day, but you cannot keep doing this forever. So in reality, of course, it's some kind of, some combination of, doubling the number or increasing the number of workers or increasing their hours. But this is only limited to, limited to production workers, right? Now think about the clerical staff, a secretary. When you double the production, right? When you double the output level, does that mean you have to double the number of secretaries or double the secretary hours? No, absolutely not. Why? Because although secretaries may work, their hours may increase a little. If they normally work 8 hours, and if the company is churning out twice as much output as before, then secretaries may put in a few more hours. But it's not like you need to double the number of secretaries or double their hours, right? Certainly they will get busier than before when output is doubled and sales double, right? But certainly their their numbers, or in other words, if their numbers or hours don't double, then it doesn't double with in other words with the production level. So it is constant. In other words, it doesn't change with the production level. Okay, hence called fixed cost. Okay, but operating expenses and total fixed cost are not exactly the same concept, because in microeconomics, total fixed cost includes more of the sunk cost concept. Okay, I will come back to sunk cost, but for now, you can understand it simply as initial investment. Okay, now, so suppose we assume the direct cost was $300 per unit. Let's assume indirect cost is $100 per unit. Then what comes next? Suppose their investment income, let's ignore this. Their investment income is zero. Sales revenue is the revenue price is $500. So when you have income and expenses all listed, then what do you need to do? You will need to subtract the expenses from income. And if you subtract, suppose quantity is 1,000, right? 1,000 is 1,000. If quantity is 1,000, revenue will be $500,000. Revenue will be 500,000. And total variable cost will be 300,000. Total fixed operating expenses will be 100,000. So if you subtract this from this, right? And we know what you will get. You will get about 100,000. And what is that called? Oh, that's roughly it's called profit. But this is not profit. It's too early to call it profit. It's called there's another name. Operating income, or right? Operating income or operating profit. Okay, so it's either called operating income or operating profit. Okay. So from operating income, we have to get to a the final point. The finish line is not operating income. Finish line is the net income. But to get to the net income, we still need to go through a couple of things, right? So the next thing we have to go through is the interest expense. Subtracting interest expense. You might wonder, what interest? Well, remember, if this company raised capital through sale of bonds, right? The company raised a capital to acquire physical capital, right? Like plant and equipment, right? And it needed startup capital, so they borrowed money, and then there is interest to pay, right? So that's the interest expense. You'll have to subtract interest expense first, right? And then you'll have to subtract taxes, minus taxes, right? And then you can arrive at net income or net profit. Net income or net profit. Okay, but then we have to. There are so many names, right? In other words, they don't go by just one name. Another name for operating income is also called EBIT. Okay, and what does EBIT stand for? EBIT stands for earnings before interest and taxes, right? We're gonna. Time is up, so we'll have to come back to this. But let me keep going just a little more, because it's not the right timing to cut off here. Earnings before interest and taxes is already quite self-explanatory, isn't it, right? Or is self-predicting. I mean, it's simply you can analyze the word, you can analyze the terminology, and it already, and by you can tell that the term already is predicating what it's gonna do, what comes next, isn't it right? It's predicating what comes next. It's earnings before interest and taxes. So what comes next? Interest comes next, and then comes taxes. That's why it says it's called earnings before interest and taxes, right? And then you can also come to the realization that the term earnings is another name for profit, isn't that right? It's another name for profit. Okay, so then think about it. Once you subtract from EBIT, you subtract interest, then what do you think it should be called? It should be called then earnings before taxes, EBT, earnings before taxes, right? And once you have paid taxes, then what should it be called? In other words, before paying taxes is called earnings before taxes, right? And there's a counterpart terminology here. There's a counterpart term here in the left-hand side, but I didn't write it. But after paying taxes, of course, that's net income or net profit. But you have paid taxes already, so it should be called what? It's called EAT, earnings after taxes. Okay, earnings after taxes. So just by following this, just by following this column, the logic in this column, right, the right-hand side column, right, it already gives you a lot of insight, right? Well, so time's up. So I'll come back.
All right. So that's intro video number 3, and we're gonna take a 10-minute break. And in the meantime, please meet Anna. Anna is our SI, supplemental instructor. So Anna, I'll make you a presenter here, Anna. I'll make you a presenter. So you can use these 10 minutes, right?
Hi, Professor. Thank you.
You're welcome. All righty.
Can everybody hear me? Okay, good. So my name's Anna. As the professor said, I'm an SI. So as I mentioned earlier, I'm here on behalf of the BMCC Learning Resource Center. And I'm here to introduce the Supplemental Instruction Program, or it's called SI for short. Before I do that, a little bit about myself. I'm currently a student at Baruch College. I'm majoring in finance, but I graduated from BMCC last year, and this is my 4th semester as an SI. And so far, I've gotten really good feedback from the students that I've met with. We typically work on practice problems, and I help them build their confidence on how to go about solving the problems. Also, I help them with study habits and building those study habits, which helps them do well in like the homeworks, the exams, and they usually, once I meet with a student, they usually come back for the resource. So about this program, it's one of the many resources offered by the Learning Resource Center. It's absolutely free. So it comes with tuition. It's here for you guys as a resource. The main purpose of the program is to pair students like me who have already successfully completed this course with students that are currently enrolled in the course. And how it works is I facilitate out-of-class review sessions, which supplements what you learn during the lecture. However, I'm also here during the lectures, so if you guys have any questions, don't hesitate to ask. I'm here. You can message me in the chat or like a direct message, and I'll be here to answer. Yeah, and then so over the course of the semester, which this is the summer semester, it's a little bit short, but I'll be here to support you by making myself available, like I said, in class and out of class. I meet with students in person or online, whatever your preference is. I also, students send me emails or questions in their emails. I answer them. I have a WhatsApp. I have Zoom, Teams, all of that, like different platforms. And so the supplemental instruction sessions, I schedule them like multiple sessions throughout the week, and everyone's welcome to all of them, to come in to all of them, as many as you need. And generally they're like 50 minutes long, but they can be longer or shorter depending on your needs. They're flexible, and if what I schedule doesn't work for you guys, you can also email me or just contact me in any of the platforms, and we can work something out where we'll schedule something that works for you. And so during these review sessions, what we do is we work on improving your understanding of the concepts. We compare notes. We can, like I said, work on practice examples. We also try to test you guys before any exams or any quizzes. And we work on learning strategies such as note taking, time management, learning the vocabulary, terminology, problem solving, and also building on Excel skills, which comes handy in this class. And yeah, and I'll be sending all this information and all the ways I can be reached in an email, but the one on Blackboard. So if you want me to send it to an email that's different from the one that's on Blackboard, you can drop it in the chat and I'll send it there, so you'll be sure to get it. And that's about it. So if anybody has any questions, you can ask me now or in the chat. And it was nice meeting you guys.
Thank you. Nice to meet you too.
Thank you. You're welcome.
All right, we're back. We're back. So let's go into the video number 4. Yeah, a little early, but take your time. I mean, it's 7:24. I left at 7:14. Anna took over at 7:14, so it's been 10 minutes. So let's get started with the lecture number 4. Okay, video number 4. Let's take a listen.
I have summarized what we discussed in the last video on an Excel example of income statement. So, well, this Excel file is available in that in our folder in the course materials. So this income statement is actually slightly different from the example I used before. I mean, it's the same thing, but the breakdown of the section is representative of retail business, not manufacturing, but basically summing up, right? Our sales revenue, which is price times quantity, and then investment income. Those are two major sources of income. And expenses are broken down into two major categories: CGS, which is directly related to production, okay, and operating expenses, or OPEX, which is not unrelated, but indirectly related to production. But
okay, so let me just add one comment here. I used investment income only as an example of passive income, right? But think about it. Sales revenue, which is obviously the primary source of income for any business, but that is revenue is the result of operating activity, right? So it's not passive income, but there's no so we don't. But however, we don't call it active income. But it's a result of active operating. However, investment income is relatively passive compared to the revenue, right? So rental income is a kind of passive income, right? So anyway, keep that in mind, right?
I said unrelated here to make a contrast, right? To make a contrast between directly related to production and indirectly related to production. So it's not that difficult to follow so far, because we understand what CGS is, and which is also equal to total variable cost, and the total variable cost is average variable cost times quantity, and also the average variable cost. Another name for that is production cost per unit, right? Production. I'll just abbreviate as prod. Okay, so it takes too much time. I already wrote this before the video, starting off the video, to save time. Interesting thing. I mean, there's a slight addition here, but let's keep going. So operating expenses is indirectly related to production, and it is roughly equivalent to total fixed cost. It's approximately equal to, and I said in microeconomics, total fixed cost is not just OPEX, but a lot of fixed cost consists of sunk cost, right? Which is basically initial investment. So what is a sunk cost? Let's go back to this example of computer manufacturing plant, company. Company as a plant, right? Because it's manufacturing. Now think about it. there is no manufacturing without the plant and equipment, right? So plant and equipment is the initial investment, right? You have to, there is no manufacturing that can start the business without having the plant and equipment in place first, right? And plant and equipment requires, construction, right? So it will take some, construction time, right? To, build a plant and put the equipment into it. And this cost is, think about it. Whether you produce any computer or not, and start making income, right, or revenue in this case, this cost has to be incurred already. The cost for plant and equipment must be expensed, right? So the initial investment is already sunk into this business. So that's why it's called sunk cost. And the sunk cost is fixed, isn't it right? Because the initial investment doesn't change with the production level because it's already in there. I mean, think about it. The initial investment, size of the initial investment depends on the planned output capacity. I mean, if you are planning to put out, like, 100,000 computers a year, the output, and that's the maximum output capacity. If that's the maximum output capacity, the size of the and the production, the scale of equipment, right, already fixed, right? It's set, and it cannot be stretched out like, rubber band, right? Because these are physical equipment, physical capital. So once it is, and so the investment, the amount of dollars that goes into that depends on the size of the plant, which is, in other words, the production capacity, right? If your projected or proposed production capacity is 1 million units a year, 1 million computers a year, then the size of the plant would be 10 times, right? The plant that will produce, whose maximum capacity is 100,000 units. Make sense? So all of this, so the sunk cost is already determined, and it cannot change, right? And it depends on the size of the company, size of the plant. And think about it. How much would that be? I mean, plant and equipment for making computers, it would be in the order of probably hundreds of millions of dollars, right? Because it's, sophisticated, machinery, equipment, Now, as opposed to operating expenses, which is mainly focused on, like, those things like rent, and salaries to clerical staff. So take a look at, the line items here: rent, utility, salaries, depreciation, R&D expense, marketing expense. All these things are relatively independent of initial investment, right? And I said, as I said, this income statement reflects it reflects the retail business rather than manufacturing. It reflects more, so it doesn't have anything that is, think about it, retail doesn't have plant and equipment. So size of the operating expenses would be much smaller than the operating expenses of the manufacturer. And in case of manufacturer, of course, the sunk cost will be spread over, right? It will be spread over multiple operating periods, right? In other words, multiple quarters, not just multiple in this case, could mean, 48 quarters or whatever. But 48 quarters will be like, 12 years, right? So that's the difference between the manufacturing's, operating expenses and retail's operating expenses. Now, and so if we subtract from revenue, and we assume it's actually income, but we assume that we simply assume that the investment income in this case is zero. Okay, so we can say income comes mostly from the revenue, and then from the revenue we will have to subtract the expenses. So from the income we'll have to subtract the expenses. So we subtract CGS and operating expenses, and as I explained in our last video, we arrive at operating income, or EBIT, earnings before interest and taxes, right? And from the EBIT, because the name is already, I've been telling you, self-predicting, right? What comes next will have to be interest payment, right? Because it's earnings before interest next. And after paying out interest from EBIT, then it becomes EBT, earnings before taxes, right? Earnings before taxes. But now think about it. Another name for EBT is taxable income, right? And taxable income, because that's the income right before getting taxed, right? So you pay taxes, and then you finally arrive at net income, or EAT. Now it is earnings after taxes. Okay, so net income is also called net profit. Finally, we are free to use the term profit. Okay, there's that pi, net profit, right? Okay, AKA net profit. Now, here's another thing we need to, a couple of more things we need to look into. So the operating expenses, operating income, or EBIT, is the primary indicator of the profitability of a firm, right? But in accounting, they use something, they also have a term called gross profit. Now, gross profit is actually, I don't like gross profit because it can be misleading. Why? Gross profit is nothing but revenue minus CGS. Okay, but you can understand this is incomplete because CGS is only one aspect or one element in expenses, right? To make it complete, you have to subtract both CGS and OPEX. Make sense? So then, EBIT is the true measure, first measure of profitability. Of course, the final measure of profitability is the net profit, because you can't, before you pay taxes, this is not all yours. And before you pay out interest, it's not all yours, right? So the idea is, gross profit is not a correct measure. It's just a very rudimentary, very, inaccurate measure, right? The reason I'm saying this is misleading is, think about it. If someone's telling you, and this person is trying to sell his business to you, or is trying to sell his shares in this company to you, and is telling you, well, look at the gross profit. This company has, wonderful gross profit. And let's say the gross profit is really good. Let's take this example. I'm not going to use these numbers, actual numbers here. So let's say the gross profit is something like, $1 million. So you think this is a profitable company. But anybody with basic understanding of financial accounting would understand, but that's only the direct cost. After subtracting the direct cost, what about the indirect cost? What if the OPEX was, $900,000 or $990,000 or $999,000? Well, then what's the operating income then, or EBIT? It will be only $1,000 if operating expenses are huge. Of course, in case of manufacturing, direct cost would be significant, right? And relatively, relative to CGS, the direct cost, indirect cost would be relatively smaller. But you can't completely ignore the possibility where direct cost is small and operating expenses are huge. And in that case, just using gross profit as a measure of initial measure of profit can be misleading, grossly misleading, grossly. Now, so next thing is, let's think about the interest. Of course, interest is it's the payment to creditors, isn't that right? We pay interest because we borrowed money. So this is the payment to creditors. And then taxes are payment to government. Okay, smart people quickly understand what these acronyms mean, right? You don't have to spell out everything. Spelling out everything is elementary school, right? If you're in elementary school, you have to spell out PAYMENT, otherwise you don't understand, right? But mature people make that connection quickly. Oh, what would that be? What else can it mean? Payment in this context, right? I'm saying this because, a lot of times, students ask, Professor, is there a list for, those, symbols and acronyms? No. I mean, some textbooks provide the list of, acronyms and symbols, but, that those symbols and acronyms slightly vary from one textbook author to another. I mean, they can slightly use. So interesting thing is, these terminologies vary slightly as well. Why? For example, let me. What is here? They use Notepad. What is Notepad? It's actually net operating profit after taxes. Net operating profit after taxes. So what is that? That's EAT, earnings after taxes, so net profit. But then the terminology, just depends on. I mean, if you're an expert, you understand, because what else would it mean? Net. This is operating profit, right? Another name for operating income is operating profit. So then net operating profit after taxes, right? So it is useless. I mean, it's a futile thing to have a list of. It's time consuming, first of all. But if you are following the lecture, right, thoroughly, and every time I use symbols and acronyms, you can make a side note on your own, right? Also, another thing, income. The term income. This is what I don't like about accounting, because accounting doesn't make distinction between income and profit. They use the term just interchangeably. Now, income is in gross state. I want to reserve the term income only for the gross state of income. And after subtracting expenses, then it shouldn't be called income anymore, right? After subtracting expenses, from here, it's better to call it operating profit. But I would like to reserve the term profit for net profit only. So here, I prefer to use EBIT, earnings. And I told you in the last video, earnings is the pretty much the same thing as profit. And then calling this net income is still, I feel very uncomfortable calling this income, because income should be reserved for gross income, right? So here, the better term is net profit. Okay. So, or EAT, earnings after taxes. And this is a kind of pun. It's, what pun is, right? I don't want to write this. Only in English language, right? Only in English language. This is possible, and it makes sense only in English language. Now, I told you, EBIT, operating income, you cannot touch it yet, right? Because you haven't paid interest and taxes. But once you have paid interest and taxes, you cannot touch what goes to the government's cut, right? If you touch the government's cut, then you will be in trouble, right? So you cannot touch it. But after paying out interest and taxes, then you can touch it, right? You can not only touch it, you cannot just touch it, you can eat it. Eat what? Eat the pie. You can eat the pie, right? You can eat the pie. That's why EAT and profit, really, pie, make such a perfect sense, or jive so well only in English language. Why? Because in other languages, I can't imagine, right? In French, they wouldn't. The term will be still profit. Profit is profit for, or rente. Rente or something like that. But can there be acronyms like this, EAT? Because and even if there's an acronym like that, French for eat, to eat is manger. So it cannot happen, only in English language. Now, another interesting thing, another thing is, so we have identified what interest rate is, and what it means, and what taxes mean, right? They are basically payment to the parties that are providing something. Interest is paid out to the creditors who provided capital, right? Debt capital. Then think about it. CGS and operating expenses, OPEX, are payments to the resource providers. Isn't that right? CGS goes to the providers of capital, labor, and raw material. Make sense? Operating expenses go to the providers of the space. I mean, if you're leasing or renting the plant, even if you own your own plant, it's not for free. I mean, if you didn't own it, you would be paying rent, right? If you own it, you're paying yourself the rent, right? In other words, what would have been otherwise paid as a rent, you are paying to if you're paying to the bank that loaned you money to buy that plant, right? So and also there's an opportunity cost. I mean, even if the plant space is paid off, right? Still, the plant space better pay. The plant space better be used well to the productive activities, so that if it is not used for supporting your production, it better be rented out. Then you can at least earn rental income from it, right? That's called opportunity cost. But in accounting, they don't recognize, they don't understand. I mean, it's not that they don't understand, but they don't recognize opportunity cost. But in economics, opportunity cost is a very significant part. So think about it. So these are the payments to the resource providers. This is the payment. Interest is the payment to the creditors. And what did the government provide? Well, the government provided a lot of things: infrastructure like roads, water, electricity. In some countries, electricity is public. The government. In the U.S., public utility is still private company, but in most other countries, utility is run by the government, by the state. And public education, policing, right? National defense. I mean, think about it. Without policing, national defense, and infrastructure, and public education for, if you suppose they are all absent, then will you build your plant there? There's no policing. There can be bandits, burglars and bandits and.
Well, this video just ended abruptly. We have just enough time for the next video. Actually, we should. Oh no, this was 4. Actually, I believe this was 4. All right, this is 4. So 5. Video number 5. All right. Let's take a listen. So I guess we have, just enough time for video number 5. So
we discussed, basically how we arrive at the net profit. So actually, the term you may wonder, you may have wondered. So operating, since you encounter at least 2 terms, right, with operating, the word operating in it. Actually, income statement is a description of the operating process, operating activity. What I'm saying is all the businesses engage in 3 types of activities. One is operating activity. The other one is financing activity. The other one is investing activity. And we can't go further into this, but operating activity is actually, the income statement process. So so operating activity is actually the activity starting from the process, starting from income, the revenue, and ending in operating income or operating profit, right? So then the steps after that It's not part of the operating activity. But that makes that explains why this profit is called operating income or operating profit, right? Of course, operating activity is critical in any business because they all operate to make profit, right? So anyway, then our although we stopped, we stopped at net profit, but actually there can be a couple of more steps or a couple of more actions. Actually, net profit, I've been telling you, net profit belongs to the owners, but owners don't get this distributed to them, right? Company doesn't pay it out to them. And I've been explaining why. It's because companies need to reinvest this profit, right? Companies need to reinvest it for its own growth. Now, as a shareholder, if you want to collect your own profit, right? Your share of profit, what do you need to do? All you need to do is simply sell your own stocks, simply sell your shares, and the shares, current share price reflects the profit. Why? If the company has consistently been making profits, significant profits, that will be reflected in the share price because in the market, everyone will try, it will be in high demand, that stock, that company will be in high demand, and everyone wants to buy that stock. So the price will automatically appreciate. Now, of course, sometimes it is over-evaluated in the market or under-evaluated, but assuming that the market's evaluation of this company is fair and just, unbiased, then the price will reflect exactly the increase due to the profit, right? But then, if you're not selling the stock, I mean, you can keep holding on to that. This is not the right time to sell yet, but you still want to see some of it, some of the profit. Well, then company pays out dividends. Of course, I've been telling you, dividend is not an obligation. Right? Dividend is only an option. It's not an obligation. So some companies may or may not pay out dividends. And if they pay out dividends, it's supposed to be some percentage of the profit. So they'll pay out. So think about it. Pay out dividend. You should have already seen profit. That means dividend is some fraction of the profit from the past. In other words, in the previous operating period. And what is the basic unit of operating period? Quarter, right? So from the quarter, let's say, so the dividend. So we are in third. April, June, July, we still are in the second quarter, right? But at the end of July is the end of the second quarter. Now, but then think about it. If a company pays out dividend in July, in the second quarter, and I'm sorry, we are in the third quarter because second quarter is April, May, June, and we have just begun the third quarter. And if we receive any dividend in the third quarter, it will be sometime around August, right? Sometime. But just because we receive dividend in August, that doesn't mean that's the dividend from the current quarter. Why? The current quarter has to end to calculate profit from the third quarter. Make sense? So what you receive actually in August is the dividend from the second quarter, right? Now, and companies cannot just pay out dividends immediately as the quarter ends because first they will have to close the book, right? Compile the data, and they will have to calculate the profit or earnings. So usually, the beginning of the new quarter is usually called the earnings season. Why? Because that means companies are compiling their data and calculate the earnings of the previous quarter and release that information at the beginning of the new quarter. So that's the earnings. That's why early. Like the first month of the new quarter is always called earnings season. And then actually the dividend gets paid out in the second month of the following quarter. So, so dividend is supposed to change with the profit level. I mean, because dividend is some percentage of the some percentage of the profit. Let's say it's called dividend payout ratio. And if dividend payout ratio is 10%. That 10% will, the calculated result of that 10% depends on the profit, right, of the previous quarter. So it is supposed to change with the profit, but in reality, dividend is only a token amount. It doesn't even change. Usually it's a constant amount. Because in reality, they pay out dividends based on the expectation, forecast of the profit at the end of the year, and you just divide it by 4 and pay out quarterly dividends. So it's not necessarily based on the past quarter's performance. I mean, theoretically, it is supposed to be that way, but they just pay a fixed amount, right? In reality. So suppose, they pay out dividend, and this is a positive number, and if you subtract that dividend from net profit, then it's called retained earnings. Now, suppose they don't pay out dividends. If they don't pay out dividends, as soon as 0, then the entire EAT, earnings after taxes, is the retained earnings. Make sense? All right. Then let's move on to the balance sheet. Okay, let's move on to the balance sheet. Let me. Usually, balance sheet. Oops, I'm sorry. Okay. So usually, the balance sheet is. It can be put, I put it side to side, but it can be put, top to bottom. What I'm saying is, okay, first of all, I've been telling you that the balance sheet is not about the profit, but it is about the capital structure. Okay, capital structure. But then what is capital structure? In a very simple term, capital structure refers to the composition of capital. In other words, how much of the total assets came from equity, and how much of it came from debt or liabilities. Now, think about it. In this example, total assets, right, is almost, let's call this, $10 million. Just, okay, 10 million. Actually, this would, all the numbers are expressed in thousands. Okay, numbers in thousands. So this is more like, 10 billion. Now that makes more sense because so this is like, it's not 7, it's 10. Let's assume that this is 10 billion. Now, so first question. So where does that 10 billion go to? I mean, why do they need 10 billion in the first place? How do they raise 10 billion? And the second question is, 10 billion, most of it is, and we still assume this in computer manufacturing, like Dell. So in any manufacturing, right, I've been telling you the most salient feature of manufacturing is the plant and equipment. Okay. So, and then land and building, right? Plant and equipment and land and building are significant part of the significant, capital need, right? You need capital to. So suppose the plant and equipment, land and building is 9.5 trillion. This plant and equipment is also called fixed assets, or real assets, or physical, because they are literally physical in nature. Real assets, also called real, or non-current assets. And non-current assets. Now, here's the term assets, right? So if you look at the balance sheet, right, and for manufacturing, a big part of the balance sheet is non-current assets or physical assets, and relatively a smaller portion is called current assets. And current assets are all liquid assets or financial assets, right? So in other words, non-current assets are fixed, physical, real, right? Whereas current assets are generally financial assets. So they are listed in the order of liquidity. Okay. So from highest liquidity to the lowest liquidity. We talked about liquidity already in the previous topic, right? And it can be defined in on 3 levels, right? First, a very basic level, how easily it can be turned into cash. Second, cash flow. Third, money supply. So it's not difficult to understand what cash and cash equivalents are. They are highly, cash is most of it. Cash equivalents are very liquid short-term debts. And marketable securities, yes, but part of the marketable securities are like stocks and bonds. Stocks and bonds. Bonds are relatively not changing in value that much, right? Of course, bonds also change in price, but the swing, the range of the fluctuation is that the stocks fluctuate a lot. So stocks are not considered cash equivalent because to be considered cash equivalent, it has to maintain steady value like cash. And I will get back to promissory notes and accounts receivable later, but that already explains how liquid, right, current assets are. And the term current actually is, I think current means present. Yeah, that's true. But in this context, current means running, right? Running. Now think about it. Liquid assets, a liquid runs, right? It can easily change hands, right? Like cash. Cash can change hands. Most liquid assets. Compared to the non-current assets, plant and equipment, it's hard to liquidate. I mean, it doesn't. It's not impossible. It will take. It may take years to liquidate, right? So in other words, as opposed to the current assets, which is running. I mean, literally, it means current means in English language, the only way you can associate it with running is like the current stream in the water, right? The current in the water, right? Obviously, that means the flowing, running of the stream, water, like Gulf Stream. Actually, current, French for current is courant. Courant means running, literally. So present progressive. As opposed to current assets, all the non-current assets are fixed, right? And they take a lot of time to liquidate. Now, but think about it. Because out of 10 billion, right? I mean, you need at least 9.5 billion for the plant and equipment, and then 0.5 billion, the remainder, is you need it as current assets. So total capital requirement is 10 billion. Okay. So how did they raise 10 billion? How did they raise 10 billion? So if you think about it, there are only 2 sources, right? 2 sources of capital, 2 sources of funds. One is debt, and the other one is equity, right? Equity is, we know that it is owner's capital, meaning that the suppose we are starting up this company, right? Then there must be original owners or shareholders or partners, and so they chip in. Original shareholders chip in, let's say 4 billion, right? And then because total capital requirement is 10 billion, then 6 billion must be raised through debt. So, and debt is called liabilities, right? Okay, this one here, liabilities, right? This is almost 6 billion, right? Consider that 6 billion. And debt can be raised in, debt can be classified into either long-term debt or short-term debt, right? Long-term debt hold non-current liabilities. They fall into two categories. Either bond. You borrow from the bond market, or you borrow from the bank, mortgage loan. But mortgage is usually requiring some collateral, right? So obviously this mortgage is for buying, building, and land. I artificially matched them. If you got $3.5 billion in mortgage, what was that for? For building and land, right? And then they sold $2.25 billion worth of bonds, and the rest is current liabilities. And I'm gonna come back to current assets and current liabilities later. But this is basically by looking at this, you can tell this $10 billion total assets came from 60%, because $6 billion came from debt, $4 billion came from equity. So their capital structure is 60% debt to 40% equity. I'll have to. All right. Okay, that's what is meant by capital structure, and it is a very critical indicator of how likely is the company to default. But by any common sense, it's easy to understand that as this capital structure is skewed more to debt. For example, 40% equity and 60% debt is already significantly leveraged. Leverage means use of debt, which means default risk is significant. It's obviously you can tell the company is not likely to default if the capital structure is 10% debt and 90% equity. Makes sense? But as the debt ratio goes up, if the debt ratio is 70%, and a capital structure is 70% debt and 30% equity, this company is already in very severe financial distress, right? Meaning the burden of servicing the debt is very high. It's called financial distress. Suppose it is 90% debt and 10% equity. Most likely, all of its earnings will be all eaten up by paying debt, right? Paying interest and principal. So capital structure is a very important indicator. So now we're going to come back in the next video. We'll need to define what assets are, what asset is, right? Okay. So that's it for now.
All right, so that's the fifth video, and so we have covered. To completely, we still have video number 6 and 7 left, and so tomorrow, Thursday, we're going to be covering the. I guess we may be able to cover up to. I think these are 1 hour video, but that we'll find out as we go along. So any questions up to this point? Any questions? But you understand this is like a crash course, because we have we have 5 weeks, and we have to cover so much material, so much content during this short span of 5 weeks, which is actually 20 days, right? 20 days. So it's designed to be it's meant to be a crash course. Okay, so you really need to be very diligent and really keep up with the progress of the class. So any questions so far? Any questions? Any questions?
No questions. I just want to double check. The test is due tomorrow night at 11:59, right?
Yeah. There's some echo in the audio in your microphone, but
oh, sorry.
Yes.
Sorry.
No problem. You were asking about the deadline, right? Yeah, it's due. This one is due, right? This one is due tomorrow, right? It's quite visible. This one hasn't started, but it's gonna start on the 28th. So over the week, during the weekend, right? Um, so it's one after another. Yeah, and also, all the concepts that I have covered in the video are also all summarized in this PowerPoint, right? So that might you have seen enough. You have seen enough. Actually, it's a matter of uh, actually, if you have time, uh, it's not that difficult to do this exercise, right? Which is the first two files, right? Okay. All right. So if there are no further questions, right? No further questions. Uh, we'll call it a day. And so have a great evening, everyone. And I will see you guys tomorrow. Okay?
Thank you,
All
Professor.
right. You're
Bye, everybody.
welcome.
Have a
You're
good night.
welcome. All right. You're welcome. If you did someone say any questions? Did someone say no? All right. I'll stop recording. Recording